Hi, everyone. Thanks for joining our webinar. My name is Adam, Content Marketing Specialist with Schein, and I'll be your moderator today. I am excited to welcome back Mark Rosen to present on 2020 tax planning. Mark will be with us 3 times this year to walk you through your tax do's and don'ts. If at any point during the presentation you have questions, please type them into the questions section of your control panel, and we will be sure to cover them at the end of the webinar. Please make sure that your volume is up and any large computer applications are closed to ensure a smooth connection. This webinar is presented by Schein Dental, and no CE credits are being offered for attending this presentation. Mark, glad to have you back with us. Please enlighten us on 2020 tax planning.
Okay, thank you very much, Adam. I appreciate the introduction. So welcome back, everyone, for those that joined me at the end of 2019 for the year-end planning. And now we're going to do tax planning for 2020, which is a little bit part of the same, but it really begins now. So first thing we'll do, introduce myself. My name is Mark Rosen. I'm a partner at Rosen & Associates, which is an accounting firm based out of Westborough, Massachusetts, a little outside of Boston. We focus exclusively on the dental industry, a little over 800 practices with probably around 1,500 or so locations. We also work on emerging DSOs, which is obviously a popular topic nowadays. I have a couple other companies that we're part of, a consulting firm, transition company, and obviously a good partner with Schein. So enough about me, but on to the disclosure very quickly. First of all, before I get going, it's a little warm here in Boston, about 70 degrees. So hopefully it's warm where you are today, but we'll get going here. So first, let's talk about 2019. So obviously the year has passed, the year end is gone. However, tax time is upon us. So for starters, be nice to your CPA. Hopefully you've sent your information into him or her already, and they're getting going on what they're doing. But there's still a couple things that you can do for 2019 to help your tax situation if you find that all of a sudden you have a tax balance due. So let's start here. So first of all, business deductions. Now, this applies if you are a business owner or you are an independent contractor. If you are simply an employee working in an office, business deductions don't apply to you. They took away in the last tax rule change, they took away the unreimbursed employee expenses. So you can no longer get that if you're an employee. Anyway, however, let's go back to if you are a business owner. So for one, if you have multiple offices, then looking at automobiles should definitely be on the books. Let's talk about auto for a second. So for an auto to be deductible, okay, there needs to be a business purpose to it. But commuting is not deductible. That's the important thing. However, let's say that your office is 10 miles from your house, but the bank is 1 mile from your house. So from your home to the bank every morning, that's your commute. That's your business stop of the day. That first business stop of the day is your commute. But then from the bank to the office becomes deductible. On the way home, okay? If the post office is also on your way near your house, you can go from the office to the post office. That's deductible, but then post office to home is not. But the IRS says that you're supposed to have an automobile log, tracking your miles, tracking where you've been. And on the same front, on meal log, when you go out with someone, you're supposed to track who you've been with, what you discussed, and so on. So the more documentation you have, the better. Now, as the accountant, the CPA, I don't necessarily need the documentation, but I'm going to ask you if you have the documentation, because if you were to get audited for any reason, you would need to, and that was questioned, you need to present that documentation. So the more you have, the better. But one of the things that a lot of people will not include during the year is think about these things, or maybe a cell phone that was paid personally. So even though you didn't pay for it during the year out of the business, there's still an opportunity to reimburse yourself, with a journal entry, an accounting entry to get the deduction. So that's definitely something you want to look at as you finish off 19. Another thing is an HSA contribution, health savings account. And I'm going to talk about this more also. However, if you already have a health savings account, okay, meaning you would have already had to have set this up, you can make your contribution all the way up until April 15th for the year past, okay, similar to an IRA contribution, which we'll go into also. So an HSA, only if you have that high deductible plan already will that come into play, the maximum of $7,000 and $3,500 for family and single, okay? Another thing you can still do for 19 is a IRA contribution. Now, I could spend an entire seminar talking about IRAs and retirements, okay, and I'm going to hit on that a little bit later on when we talk about 2020. But for this year, or for 2019, you can put in a traditional IRA. That will be a deductible, most likely, depending on your situation. A Roth IRA, you can still contribute, or a SEP contribution. A SEP is pretty much best for the independent contractor that has no employees, possibly works in one or a couple offices, has other business deductions, and can make a retirement plan up to 25% of their net income on their Schedule C. So there's a possibility of a retirement contribution. So that's really the question you would say to your accountant that's doing your taxes. If you don't have a plan in the office, the question simply is there a retirement contribution that I can make that will benefit me tax-wise? Now, the fourth thing that's probably the largest deduction of them all potentially is a cost segregation study. And I love cost seg studies. I talk about it in all my webinars, all my seminars, because it can have a huge impact on taxes. But the good thing about cost segregation is you can still do it during the 2020 year and go backwards and apply it to 19 if you go on extension and you don't file your tax return. So what I'm not mentioning here is if you do go on extension, it's an extension to file, not an extension to pay. Any tax is always due April 15th for the individual returns, March 15th for the corporate returns, except for a C corporation, that's also due April 15th. But you need to pay your tax now and you can extend. Why you would do that? Saving for retirement, or in this case, maybe a cost segregation study takes a couple months to do, and therefore you'd want to get that done. So now let's move on to 2020 planning. So right now you are essentially building your foundation for the entire year, okay? So everything you do now has that impact down the road. And when you're down the road and we have that webinar again in October, these are the things you wish you had set up. So might as well get them set up now. All right, so let's start with a salary. Now, the only time you're going to have a salary is if you are an S corporation. Okay, if you're a practice owner and you have an S corp or you have a C corp, and if you've ever heard me speak, I don't know if you have, I don't like C corps very much. We're going to talk about entity structure, and I'll go into why. But setting your salary is important, especially if you have a retirement plan. So let's start with the retirement plan piece. Retirement is calculated on a maximum salary of $285,000. So therefore, if you have $1 million of income, you have $1 million of income, and all you want to do is $1 million of income, you want to only, or actually retirement is only going to get calculated on $285,000. So do you need $1 million in salary? Maybe, maybe not. That's going to be a question. Now, I'm going to keep my eyes open on the chat, and it's a what is a cost segregation study, and I have a whole screen on that coming up, a couple screens. So I'm going to go into that in a little more detail. But for retirement purpose, 285. So if you have a plan that matches, it's a match of 3 or 4% on 285, not the $1 million. Okay. Now, why else do you want to set a salary? If you are an S corporation or a C corp, really, but we're going to focus really on S corps when you talk about salary, you want to use the salary to pay in your taxes throughout the year. A lot of people don't like estimated taxes. You know, they're due in April, June, September, and January. So a lot of people don't like paying those because it's just, you need to accumulate a lot of money and then you're going to dump it out of your account, and it's harder to plan. So a salary allows you, just like your other employees, to take pay every 2 weeks, but really to get the money into the government. Are we loaning the government a lot of money during the year? Not really. I mean, nowadays with the interest rates and savings accounts, you're not really missing out on a lot, but you want to set that from a cash flow standpoint, right? Because if you set that salary, if I'm your accountant and I told you you need to get $200,000 into taxes, okay? You can either you could pay in 50 grand every 4 months, or every 3 months rather, okay? Or you can spread it out throughout the year and just build your budget around that. And a lot of people find that to be very easy. So if you find that you all of a sudden are an S corp and you're doing your taxes now and you owed a lot of money, okay, one of the things may be looking at your withholdings and paying in more taxes throughout the year. So it's important to set it now, because by paying the money in now, and I note this little below, it's better to pay it in earlier in the year because it will minimize penalties later in the year. The government wants their money throughout the year. However, if you do pay your salary one time at the end of the year, which you can do, I could give myself a $280,000 payroll on December 25th, okay? And I would need the cash if I wanted to pay in all my taxes then. So I can hold on to my cash, and there is planning pieces behind that. I'm not going to dive too deep into that because that takes a little more planning, but it also takes a lot of restraint, because your bank account is going to build up and build up, but you need to be able to know that you need that towards the end of the year. In this day and age, I'll be honest with you, less and less people do that. They would rather pay it in throughout the year, makes them feel a little better, as opposed to seeing the account build up and then not wondering, if it's enough to pay in taxes. So if you do pay in estimates, which even S corp owners pay in estimates, but if you are part of a partnership or a sole proprietor, single member LLC, you're going to pay estimates, okay? And that's due in April 15th, June 15th, September 15th, and January 15th. It doesn't do you any good to pay it on December 31st. You don't get a deduction for it to pay it early, so you may as well wait until January 15th. However, if you are an unincorporated business, a partnership, or a sole proprietor, you need to pay those in, and I highly recommend making the full payments earlier in the year. Meaning, if you think you're going to make less money in 2020 than you made in 19, I would make sure you're paying 110% of 19 to start with, okay? And then you can back off it for the third or fourth estimate. The reason is because the government will, again, penalize you. If we shorted the payments now and we picked it up in September, we'll still get penalized, okay? So if you are an S corporation, you do want to go on payroll with the other people. I had a question here, okay? You want to pay taxes through payroll. You're going to pay your Medicare and your Social Security. S corporation, I would pay it. I would be on salary 100%. In fact, you have to be on salary, okay? There's something called unreasonable compensation, and the government requires you to take a salary. So I'm in a screen or two, I'm going to go into kind of entity types, and I'll go through that a little more. So as we go here on to entity, a good little segue, all right? When you start your business, you build it from the ground up. It's like you do a house or your practice. But what your foundation's made of is your entity structure, okay? So let's talk about the entity structure here. So let's start with the simplest entity form, sole proprietor. It's just you, you're the owner, you have very limited liability protection, and that's really the problem with it. It's taxed as a Schedule C on your tax return, okay? But the important thing really is you don't want to be a sole proprietor nowadays because it gives you no liability protection. You can avoid that, okay? You can get that liability protection by being an LLC on the far right-hand corner, okay? An LLC functions very similar. A single member LLC functions exactly like a sole proprietor, okay? Exact same thing, except you've got some liability protection. So if someone sues you for falling on the front steps, they can only sue the entity and not you as an individual, although I'm sure they will, but you've got protection there. I'm not a lawyer, and I would get the recommendation of a lawyer also. But an LLC, a single member, is the same tax-wise as a sole proprietor, but better liability protection. So a C corporation. So there's been a lot of talk about in the last 2 years or so that a C corp has less tax rate, and it does. It has a 21% tax rate. Why that sounds really good. The only way that works is if you never took the money out. And based on the clients I have, everybody likes to get their money out of the business. Okay. So if you take it through salary, then you're not paying 21%, you're paying the individual rate because it's through a W-2. And if you withdraw it as a distribution or a dividend out of a C corp, you're in fact paying another 23% or 20%, depends on the situation. So 41% total tax rate really from a C corp compared to a top bracket of 37% on the individual side. So while 21% sounds enticing, and there are companies out there that are kind of peddling that you as a dentist should be that, it doesn't really work that way. So you really want to be the S corp. How do S corps function? Okay, it's a pass-through entity. It's not taxed at the federal level. State levels sometimes pay a couple $100. Massachusetts, it's $456, pretty small. Rhode Island's $400, but it's on the federal side. It's not a taxable entity, so the money flows into your personal return. Now, in an S corp, you get liability protection, which is good. Nothing stops malpractice, so it doesn't matter what kind of entity you are here. But one of the things you see in the middle pro screen that kind of ripples through all of them is this QBI eligibility, okay? In the last webinar, and I won't go too far into it, there's something called a qualified business income deduction. It's where you're able to get 20% deduction of your income. So let's just compare that, okay? If you're a dentist, I assume you are, and your income is below $320,000, okay? Let's take that for all this scenario here. Your income from your practice is $200,000 and all your income combined is another $100,000, okay? So the sole proprietor, $200,000, you will get a 20% deduction, meaning 20% times $200,000 gives you a $40,000 deduction. If you're at the 30% rate, that will then save you 30% of the $40,000. Okay, you'll be able to save taxes on that. Now on the C corporation, it's not eligible. Okay, you don't get to do that. But here's the difference on the S corporation. If we make that same $200,000, but I take a $100,000 salary, which I need to do, I only get a $20,000 deduction because my net income is income minus expenses, including my salary, leaves me with only $100,000 of taxable income. And therefore, it's $100,000 times the 20%. So there you can see, why would I do that? Why would I be an S corp then? Well, if my income is $800,000, I phase out of using QBI because the QBI phases out at $420,000. So if your income is over $420,000 and you are not an S corporation, you should look into that and think about being that. Or if you're a C corp, you should always look into converting to an S corporation and seeing if it's worthwhile. An LLP and an LLC both can have multiple members and function as partnerships. Okay, an LLP, limited liability partnership, has to have more than one member, whereas an LLC can have one member or multiple members. Okay, but sole proprietor, S corp, LLP, LLC are all taxed at the individual level, not at a corporate level. Okay, so lots on entity structure, and if you don't think you're the right entity, then you should definitely reach out to your CPA and ask. Okay, or you're more than welcome to email me along the way, and I can try to help too. So now let's go into 2020 planning and more planning here. So these are one of my favorites. I love having the kids on the payroll and the spouse on the payroll. It is one thing that a lot of practices don't do, but it's not a matter of you do it. You need to follow the right rules to do it. Now, first of all, There are child labor laws out there, and different states function different ways. You may need to fill out different forms to employ the kids, okay? But employing your own kids is a little bit different than employing, other kids. So let's start with how much is the right amount? Well, let's talk about the age of the kids really first. 1 year old, 2 years old, too young. Now, you could argue that if I've got a pediatric practice and I like to start seeing kids at 2 years old, maybe they come on your payroll, but they'd be on your payroll at a very small amount, okay? 1,000, 2,000, okay? But I guess before I talk about that, why do we want the kids on the payroll? What's the point of having them? The point of having them is that they are taxed at a lower tax bracket than you are typically, okay? So if I'm only paying them $6,000, and let's say I'm a partnership, okay? If I'm a partnership and I pay my child $6,000, they don't pay any taxes on that $6,000, and I get a deduction for it. So I save about $2,000 in taxes, $2,500 or so, depending on my tax bracket, and they pay none. So it's a net savings of $2,500 just from a federal standpoint. So the money, though, needs to go into their account. And I need to determine why I'm paying them. If they're going to be a model, if they're going to be a janitor, or nowadays a tech support, because they're obviously smarter than us with all the gadgets, okay? You need to pay them like every other employee. That's really the most important thing. You cannot pay them on December 20th when you realize that you got more profit than you expected. So I have 3 kids. I'm going to give them each $10,000, and I'm going to deduct $30,000. Will it work? Sure, tax-wise it will work. But if that got questioned by the IRS, it looks like that you are doing it for tax purposes only at the end of the year. And that's not what you want it to look like, right? You want to show that this person was employed. They had a job description. Their job is once a month to come in and examine all of the trash cans and make sure that they are cleaned thoroughly. Whatever it is, that job could justify $6,000. But having that job description is very important, and then paying them throughout the year. But as they get older, they can obviously do more, right? So a 17 or 20-year-old should make more than a 5-year-old. So let's talk about that kid in college. Okay, so now you've got a kid in college, and I do not have a child in college yet, but I'm pretty sure that a lot of parents are going to give their kids money to do whatever. So if you're going to give them money, you may as well make it a deduction. But how do you do it? Now, if they're in college, not in your state, you're better off just paying them in big chunks when they would be home. But they can also work during the year as your IT consultant, as your social media coordinator. Maybe they run your Facebook page or your Twitter account or your Instagram, and they help post things here and there. But if they're a student, we're now going to pay them into their account. Okay, so money goes into their account, and then they're going to write the check, or we can write it out of their bank account to the college. So they get what's called a 1098-T form. That shows how much money was paid for tuition. So once they have that, come tax time, you're going to see they got paid $35,000, but they get to deduct the first $12,200. And that's why I keep mentioning that 6 to 10 grand or even 12, because the standard deduction increased last year to $12,000, and it's $12,200 in 2019. I think it goes up a little bit in 2020 also. Okay, so that 12,000 shelters the first 12,000 of income against the 35, and the tax then is a very low tax bracket. You're in like the 10% tax bracket, which when you then have a 1098-T, it shows you paid tuition. You then are eligible for an education credit, which then essentially wipes out the tax. So if done properly and planned well throughout the year, hence now you begin paying them, you could essentially pay a college age student, not much of a child anymore, $35,000 at different times throughout the year, not in December, Okay, that's the kicker. And we could get the deduction, and you want to get that 1098T and educational credit. So it's really making sure that those pieces are all put together so you're ensuring that you have that full deduction. Okay, now the spouse on the payroll is a little bit different because if you're married filing jointly, you're on the same tax return. So if I just paid my spouse $50,000, then I'm just taxed on an additional or the same 50,000. And by paying my spouse as opposed to paying me more, I'm going to pay more money, in fact. So why would I have my spouse on the payroll? Well, the reason I would have them is only if, well, two reasons, I guess. First, if I have a retirement plan, that's the main reason to pay them. Why? Because I can pay my spouse $20,000. I'll pay the Social Security Medicare on the 20 a little bit because I can then shelter $19,000 into a retirement plan because she's part of my payroll, has been there a year, qualifies for the plan. I'll go into that again in a minute, more of that in a minute. And if she qualifies, then I can defer that in. I'm only taxed on $1,000. So what did I accomplish? Well, I got a $20,000 deduction by paying my spouse, but then I only picked up $1,000 in income. Okay, so extremely beneficial to do it. But again, spouse paid throughout the year, just like every employee. That's really the most important thing. Okay, so now let's talk about an HSA. Now, I mentioned that earlier, but that's if you already had one. So if you don't have one, and you want to set one up, it's that you need a high deductible insurance plan. So it's typically premiums over $2,000. You'd have to look up exactly what qualifies, but I believe it's around $2,000 of monthly deductible. Then, I'm sorry, not premiums, deductible. If your deductible is $2,000 or more, you're probably in a high deductible plan. So if you're in that high deductible plan, you can create an HSA account. Well, what's the benefit? Well, there's no income limitation to deducting upwards of $7,000 if you have a family plan on the front page of your tax return. So it's 100% tax deductible no matter how much money you make, which is great. But another big thing is it's not a use it or lose it. So here's a planning point. I put in $7,000 this year and I choose not to use it. How do I use it? Prescriptions, co-pays, x-rays. I can use it for anything medical. I get a debit card typically, or I get reimbursed. I can reimburse myself because it comes with a checking account, because that's just really a bank account. But if I put $7,000 in and don't use it, then again, $7,000 the next year, don't use it, $7,000 the next year, and I keep doing this, I could end up with hundreds of thousands. However, to get the money out, it's got to be used for medical purposes. But I can use it for long-term care used down the road, or maybe a nursing home. I can use it from that purposes. It's another way to save money for that, getting the tax deduction. But again, you need to set that up so you can use it for current or future medical needs. But again, no income limitation. That's the important part. So let's go into property. Okay, so if you own property, there's different types of planning. So let's start about owning your building. The first thing you want to do is look at your rental agreement with your rental company, with your property. And mostly, hopefully, you have your practice in one entity and your building in another, preferably an LLC or a trust. Those are what's pretty common nowadays. But if you're an accountant, if you, let's say, rent your building, but you own the building, your dental practice occupies a small space, but you have other tenants, sometimes it's going to be considered a passive activity. Okay, passive activities that have losses can only be offset against passive income. So if you don't have any passive income, what do? Well, we can create more income inside your realty company by potentially increasing your rent. So you want to take a good look at your rent, because if you happen to have carry forward losses, because it's considered a passive activity, you could eat those up by increasing your rent. Something reasonable though. A reasonable rent is usually 4 to 6% of your collections. That's one of the things that you want to see if you're in that wheelhouse, or you can look at other properties in the area and see what rent is and kind of compare it. Have I seen rents in practices at 7%, 8%? Sure. Is it questioned? I haven't seen it questioned, but maybe you need to justify that rent and make sure that you're paying proper rent. So definitely something to look at. Now we're going to get into kind of fun stuff, okay, which is if you own the building outright, it's just meaning there are no other tenants typically, or even if there are, actually, you can do that cost segregation piece. And you know what, I'm going to hold off for a second on that because we're going to touch a little bit more on that on the next screen, I believe. If you are an S corporation, you have the ability actually to rent out your home. Now, how does that work? So there are IRS rules out there that say that you can rent out your home for less than 14 days and don't need to pick up the income. So let's say I have a staff meeting at my house once a month. I pay $1,000. So meaning my company pays me $1,000 to rent my house, to provide the facility to have that meeting. Maybe it provides the food also, whatever. I can take a $12,000 deduction out of my corporation, $1,000 each month, paid each month, not at the end of the year. Very important. Okay, paid each month. And Mark Rosen does not have to pick up that income on my personal return because I rented it less than 14 days during the year. It's a reasonable rent. If you're an LLC or a sole proprietor or a C Corp, you do not have the eligibility to do this. You're not eligible to take this deduction. But it's got to be a reasonable rent. I can't rent my house for $10,000 a month when I could go to a hotel for $300 because that is where you will get burned. Okay, so you need to be very careful as to when you're making the payments, documenting why you're making the payments, and tracking it at different times and charging it appropriately. If you host events at your house, not for your patients necessarily, and that does count a little bit, okay, but it's really your staff. Sometimes your patients or potential patients, those could work. It's all about documentation. Really about documentation and knowing how do I have a talking justification about what I'm doing. Okay. So, all right, let's talk about cost segregation. So first, let's talk about, actually, I'm back here. What is cost segregation? So cost segregation is the ability to literally segregate the cost of a building or a build out. So when you buy a building, it's brick and mortar, right? Doesn't matter what's in the building. And this does not only apply to dental practices or dental building, it applies to any property. Investment property only. Commercial property, not your home or personal residence, okay? I buy a building for $1 million. That building depreciates, gets written off over 39 years. Say it's a rental, it's commercial property. 39 years is a long time to deduct a building, okay? 39 years is a long time to rent out that building. So therefore, okay, I'm not so rent out. 39 years is a long time to depreciate the building. So I don't want to wait 39 years to write it off. So one of the options is to do a cost segregation. Cost segregation company, which is an engineering firm, goes into the building and looks at everything from the drop ceiling to the light switches to the carpet. So let's say carpet. If carpet is stapled down, I can then rip it up. So what does that make it? It makes it a 5-year property. But if it's glued down, it's part of the building and I can't really remove it without really damaging it. So therefore, it's part of the 39-year property. So the engineering firm goes piece by piece and breaks it all down. Okay, so as you can see here, I've got that $1 million building. Now, originally, I had $1 million and nothing broken out without a cost segregation study. But with the cost segregation study, I now can break 200,000 into 5-year, 7-year, 15-year. By doing that, I'm accelerating the depreciation in the early years and therefore getting the benefit as I just buy the building. I'm getting situated. I'm making bigger loan payments early on and to get things started so I can shelter a lot of income. Now, as I mentioned before, a rental property is oftentimes a passive income or a passive activity. However, if you occupy more than 50% of the building, you can potentially aggregate, meaning like mesh the building and your business and the practice, not literally two separate entities, but on the tax return, have them taxed together. By taxing them together and you create a loss inside the cost segregation study, you then can use that loss to offset the income of your practice. Okay? So each cost segregation study is different, and there's no really rule of thumb that you can estimate, okay? But if you do a build out, okay, you do a build out, it works the same way, and we're gonna go through that next. But just because I have $1 million building, it doesn't mean that, almost 30% of it is going to be other than 39 years. It varies by every building. It just depends on the building and the build out. But I do know, at least the companies I work with, you can get free estimates. You give them the building, you give them the location, and they will give you a good ballpark as to how much benefit you're going to get from that. Okay, so let's look at a build out. Okay, it doesn't have to be a building because you could rent the facility, do a build out, in this case, a $500,000 build out. So what are they breaking down? They're really breaking down the plumbing and electrical. That's the big difference. So I'm an accountant. I go into a space. I need bathrooms. I need lights. I need electricity. I need the plumbing that goes along with just a normal office building. But what I don't need is an operatory plumbed or dental electric work. So that's the type of work, which is most of the build out or a good portion of it, that goes into that 5-year property. So the 5-year property can be written off much, much faster. And if the build out, okay, is inside of your practice, which I highly recommend doing the build out inside the practice as opposed to inside of the realty company, meaning the entity. Okay, clearly the build out is done in the building, but the deductions I want in the practice from a build out. Why? Because now I can write it off quicker through section 179, which is the ability to write everything off faster in 1 year potentially. Okay, I'm not going to go into that too much, but when you buy equipment, as you know, you buy it through Henry Schein, we can write it off in 1 year if we want to, without creating a loss, but we have the ability to do that. So you want to plan accordingly from a tax standpoint. If we're doing a big build out, if we're going to do a cost segregation, we want to get that in play as early as possible. Why? Because remember when I talked about salary and paying in your taxes or estimates, that will obviously change what you're doing. That will drive a different tax number if we have these large deductions. So here's a good graph. I'm here with a cost seg. It's going to push most of my deductions into that blue. And then I get a little piece along the way that you can barely see. Okay. I'm going to get the same deduction if I hung on to it for 30 years. But I get to shove a lot of it in the early years. And that helps me as I build the practice, helps me tax plan and do that type of stuff. So I highly recommend looking to a cost segregation study if you don't know much about one. Okay. So during the year, what do we want to look at? All right. One of the things, and we touched on it before, it was kind of at the end in the very beginning, those discretionary expenses, right? But that's not a typo. I purposely wrote documentation twice. If I could, I've written it like 10 more times. But the reason is because it's so important when you have auto and travel and meals and CE. Now, CE is, when you travel to a seminar somewhere, okay, you can deduct the flight, the hotel, the class, the meals. You can deduct those things. But you got to be a little careful. If the CE class is 1 day and I go to Hawaii for 3 weeks, the rest of it's really not deductible, okay? What's reasonable, a couple days before, a couple days after, paying for part of the hotel, but really documenting it. Again, why the documentation? If you ever get audited, okay? I like to see a documentation as a CPA to help me understand where these deductions are coming from. But I don't, I'm going to take my client's word for it for the most part, because they're the ones that have to represent that they've actually gotten that deduction. But as you're spending during the year, what a lot of people don't think of is that it's still cash, right? People, where'd my cash go? Well, you spent $20,000 in travel, and there were a couple CE classes in there. Well, maybe that's where your cash went. People spend their income different ways, in the discretionary piece or just taking the money out, whether through salary or through a distribution. So you need to be a little careful about that. But when you're looking to save things, because planning is two things, right? There's tax planning, which we've kind of talked about, and then there's practice planning, right? You want your practice to be efficient, to run within the metrics. And my webinar in July is going to kind of dive a little deeper into the metrics portion. But here, you can see some examples of key expenses that you kind of highlight, right? So you've got dental supplies and lab expenses kind of combined. We'll combine them here for a second. 10 to 14% of your practice. So if they're not 10 to 14, if they're 18%, why? Well, maybe you do implants, and we should break that out. Or maybe you're trying to buy things from all kinds of companies where we can call Schein and say, hey, let's do it all in one place, and let's get it kind of locked in to the proper range. And having it looked at over and over again is really, really important. Now, part of it could be you're doing a bad job buying. Part of it, of course, could be that you're not producing. And so that's obviously something to look at. It's got to be one or the other. So looking at office expenses, 1 to 2%, that's kind of where the excess stuff gets put into. The stuff that you don't know where it goes. Flowers for the front desk. Maybe you're paying for Sirius radio or something. That kind of stuff will go into office expense. But those Amazon charges kind of build up over and over and over again. Okay, just so you want to be careful there, because you don't want to do that. You want to minimize your buying, and you want to look at what you're buying, okay, and make sure that we're kind of following in these lines. And it's not a bad thing to have this budget set and review it during the year, 6 months. Am I in line? When we look at practices, we're looking at benchmarks, and I can do that because I've got 800 practices or so, compare them with each other. And I have a how to compare booklet you can download on our website, which helps give some of these numbers. So then obviously spending during the year in purchasing equipment is important, but we don't necessarily just want to do it for the tax deduction. I don't like buying just for the deduction, because what happens then is, let's just say, and I will be willing to bet that someone's going to come to this time of year who didn't do any planning, and they're going to say, I bought a lot of equipment in 2018, okay? 2018, I bought $200,000 worth of equipment. I wrote it all off in that 1 year. And in 19, I didn't buy anything, but I did the exact same amount of dentistry, same income. What's going to happen? Your income is going to spike by about $75,000. Even though you didn't do anything different, it's because your deduction is gone. You deducted all in the first year that you had it. And so planning to buy that equipment throughout the year, if you bought it throughout the year, not just at the end of the year for the deduction, is just as important. It's the same deduction, but you do a better job planning. And that's really what, wanted to talk about. So keep moving along here. So retirement, I mentioned it before as to things you should put in place. And that was in 19 to get some smaller retirement deductions. But really, now is the time to implement a plan. Okay, lots of words on the right-hand side of that page, because different types of plans. Personal plans, traditional IRA, non-deductible IRA, which is a traditional that you can't deduct, a Roth IRA, which grows tax-free. But there are certain income limitations to having a Roth IRA. You can do backdoor IRAs, but won't get too into that really. But practice plans, and this is really the important part. SEPs, Simples, 401ks, profit sharing, defined benefit, or cash balance. Those plans, other than a SEP, but let's add it in there, should be implemented throughout the year to not only help with cash flow throughout the year, but also to give your employees a chance to put money in if you do a 401k plan. And you really want to spread that, income out. So just like you're taking a salary throughout the year, if you're an S corp, and we spread out the cash flow for taxes, if I'm able to put $19,000 into a retirement plan, 401k, it's sometimes hard to come up with that in November or in October if I put a plan in right at the end of the year. I want to put it in now. So therefore I can spread out my contribution, or even spread out your profit sharing amount. Now maybe we can save it on the side and put it in a savings account, but you want to establish the plan now and then get an idea of what that cost will be for your staff so you can plan ahead, because retirement contributions are due by the time you file your tax return. So if I have a 401k plan with profit sharing and I'm going to pay $60,000 for me and my staff, if I want to file by March 15th, I need to pay the 60 by March 15th. If I want to wait until September 15th as an extension, I can do that. But it's establishing the plan. So a couple changes that are taking place in 2020 are if you have a plan and you want to take the money out, you used to have to take it out by 70 and a half, kind of a weird age. So they actually just moved it to 72. So if you're not already taking a distribution and you are in your 50s or 60s or even younger, whatever it may be, you can start taking it out when you're 59 and a half if you want to, but you have until 72 years old in all the plans except a Roth. A Roth never needs to come out because it doesn't have any required minimum distributions, but your other plans do. But now you have the ability to take out plan withdrawals of $5,000 now to cover childbirth or adoption. So it's another way you can get your money out of a retirement plan without paying that 10% penalty if it's before 59 and a half. Okay. And now, even if you're older than 70 and a half, you can still contribute to an IRA if you want to, whereas in the past, there was a maximum age and you couldn't do that. Okay. So 2020 now, there are more or bigger benefits to actually putting a plan in. Now, instead of there was a $500 credit for putting a plan in, now they've jumped that to $5,000, okay, for up to 3 years. Now, you can only get that credit depending on what you spend. So if you spend $5,000 in setting up the plan and paying for it with a TPA, then you can get the credit. So you don't just get the credit and do it yourself. But if I recommend a retirement plan, they're very valuable, huge benefit for the staff. Nowadays staffing, as you know, is very hard. Keeping staff is hard, so giving them benefits to stick around is obviously important. Okay. So I thought I'd throw this in there because it throws off a lot of people come tax time. Okay. I see tax returns sometimes, and inside of people's investments, mutual funds, stocks, there are mutual funds that kick off capital gain distributions, because people will say, I didn't sell any stock. Why do I have such a big capital gain? It's because your investment advisor, or maybe you, put yourself in a mutual fund that kicks off a lot of capital gains inside of the mutual fund. So it's not, the mutual fund itself isn't sold, but the stocks that are making that up are sold repeatedly, to create that capital gain. So therefore, you're going to be taxed at capital gain rate or on capital gain money, but you never knew you never knew that you even sold anything. Okay. So a quick question here: what are promotional expenses? Average gross income. So advertising, I'm going to jump on that for 1 second. Typically 1 to 3% marketing and promotion stuff. It can vary depending on what level you're at, meaning startup, it's going to be huge. Existing practice, going to be much smaller. So hopefully that helps you there. So the last piece in investment planning here, harvesting losses. In other words, if you know that you have losses, the market's obviously gone up and down, or down primarily recently. So maybe there are big losses and you're going to sell your practice this year. Typically when you sell a practice, a portion of it is allocated to goodwill, which is capital gain. So you want to offset capital gains against capital losses. So if you've got big losses now and you're looking to potentially sell, then you may want to create those losses and then utilize them when you go to sell the practice. Okay. So practice planning a little bit. So as you're planning during the year, I highly advise doing these couple things, if not lots of others, but these are just a couple. Lots of people nowadays are thinking, what's my practice worth? Can I sell it? Can I, what will I get for it? So you need to step back and look at your practice. Do a self-review. Would you buy your practice? If you stepped in there and the paint's chipping and the carpet's old, that's not much money to change that over. Coat of paint, okay, maybe a new carpet for a couple $100. It goes a long way for your patients. Your patients walk in and say, it's kind of an old practice. They don't want to recommend that to their friends. But if it's a little nicer when they come in, you want to, encourage that, obviously. Sounds simple, but a lot of people don't do it, okay? Now we get into nitty-gritty stuff, acceptance rate. You can try all day long to treatment plan and treatment plan and treatment plan. But if no one's accepting what you're doing, then you may not be doing something right, or the person that's selling the plan, selling the dental plan that you've laid out, if they're not doing a good job, you need to evaluate that. 85% or better is really where you want to be on the acceptance rates. And there's lots of softwares that can help you look at that. Fees. Now's a good time to look at fees. I encourage adjusting fees every year, not necessarily all across the board. You want to look at kind of your procedure count. How many pro fees did you do? How many crowns did you do? How many, onlays did you do? Why? Because to move that $1 or $2 or a couple dollars will make a big difference. Changing a fee with a procedure you do 3 times during the year doesn't really do you any good. So evaluating that, there's software out there. I know we have a software. I believe Schein may be able to look at fees. So you can evaluate that and see if where you are. I like people on about the 70th percentile, but we can run fee counts per code, what we'd run for our clients, per zip code. So clients of ours will get that as a free service. So, and then where are the holes in your practice? People say, it doesn't seem like I have a good hygiene program, and they look and the hygienists are producing 50% of the practice and the dentists are producing 50%. Well, that's not good. That means that the dentists are underproducing. Because they should be 2/3. So kind of looking at that throughout the year. And then last year is really thinking out of the box. Look at your practice. Should you acquire practice and absorb it in? Do you want to plan for that? Should change your culture, moving in a new space, equipment, merging, acquiring a specialty practice. All of these things take planning and starting at the beginning of the year. Again, this is not for the tax deduction. This is for the growth of the practice. You really want to look at these things and really step back and say, what if I did move into a bigger space? Or there's a retiring dentist nearby. What if I just bought the patient list and absorbed it in? What will that do? So definitely something to look at there. So one of the groups that we're part of here is called the Academy of Dental CPAs. So Rosen Associates is one of the founding members. You're from all over the country. I can't see where you're from. So we handle all the stuff in the Northeast. None of us compete with each other. We meet twice a year, but I highly recommend speaking to the ADCPA member in your area. I can be reached at mrosen, so MROSEN, at rosendentalcpa.com. And then I will leave it off to Adam here, but I appreciate you joining me again. Hopefully you'll join me in July.
All right. Thank you, Mark, for that presentation. We do have a couple minutes left, so if anyone has some last questions, feel free to type them into the questions tab. Is the retirement plan deducted through a business account?
A traditional IRA is not, but a 401k, a profit sharing plan, a simple plan, a SEP plan are all deducted inside a business. Other than an IRA is really traditional IRA is what's not deducted in the business. The other plans are.
All right. I think you answered this one already, but what are promotional expenses and what is the average percent of gross income it should be?
Yeah. So I did mention that, but promotional expenses, advertising, same type of thing. 1 to 2% of a practice, an existing practice, 1 to 3%, in the growing stages, but startups, you could see that 10, 15% of a startup fee, clearly, because we're going to kind of get going. But typically once the practice gets going, nowadays AdWords and online campaigns and whatnot, you see about 1 to 2% of the practice gross collections.
Is there an advantage when selling your practice and you own the building and are keeping it for rental income after the practice has sold to showing higher rent?
There could be. What it shows is what really shows from the practice standpoint. The practice can handle a lot of rent, but if you're looking to sell the building, it really doesn't matter that much. Usually, it's going to be looked at the rent in the area, in terms of adjusting it for proper rent. Because if you owned it, you may inflate that. So typically, when you're selling the building, they're probably going to adjust it, and the sale price really goes on the assessed value of the building, not necessarily the cash flow of the building.
All right. If you are paying an educational loan of an associate dentist, can that be deducted?
It's not supposed to be. So if you're paying a student loan for an employee, that's not deductible. There are different education plans out there, and it might cap out at like a small number, but you need to offer that to all your employees, I believe. You can't discriminate. So in that case, you may want to pay the employee more. You'll get the deduction 100% for paying the employee more. But I'd probably put some contract in there. If you're paying the loan and they leave, you want to make sure you're covered for something. It's not your responsibility really to pay it if they were to leave. So keep an eye on that. But I'd pay the employee more if you want to do it that way as a benefit, and to have it somehow in their contract. When that loan's paid off, maybe it's adjusted somehow.
Does the 25 to 28% of staff costs exclude the FICA taxes? And is the DDS salary included in that 25 to 28%?
No, good question. And these kind of statistics we're going to talk about in July in more depth. But the 25 to 28% is just the gross salary of staff, not doctors. So no associate, no owner. It just strips down into hygiene, office, and admin. Let's just say in a general practice, or assistants in office in a oral surgery practice. But it does not include benefits, because it's very hard to compare office to office with benefits, because all offices provide something different. So it doesn't make them comparable. And it does not include payroll taxes. So your payroll taxes are a separate line item on the income statement.
All right, we got time for one more. This person has owned a building for 26 years. Is there any reason to consider cost segregation, as it seems like it's too late for them?
A great question. So, and I didn't mention this, so thank you for bringing that up. A cost seg works well in about the first 7 and under years of ownership, because 26 years, you've already depreciated 26 out of 39 years. So you've already gotten the bulk of the deduction. So it's really, you could say inside the first 10, but I think inside the first 7 years of ownership, not necessarily building it, it's when you buy it. So the building could be around for 100 years and you buy it, you bought it yesterday, you get to deduct it from yesterday. But if someone's had it for 10, 15 years, you've already taken up a good portion of your deduction. So it's really not worthwhile typically. But again, you can get free estimates from different cost segregation companies, and you can reach out to me. I'm happy to give you information on that. You can just go onto my website and touch base with me that way too.
Thank you, Mark, for answering all of those questions, and especially for your presentation. And thank you, everyone, for attending today's webinar. If anyone does have additional questions that we were unable to answer, feel free to email us at webinars@henryschein.com or email Mark. You will all be receiving a link to view the recording of today's presentation. On behalf of Henry Schein, thank you, Mark, for presenting today, and thanks to all of you for attending.